Today I'm here to give you not so pleasant news, but it's important for you to know that your MMF or your money market fund account is about to reduce the interest that they are paying you every month. Let me say that again. The interest that your fund manager has been paying you or is paying you is about to reduce. And why am I saying that? It's because, like I've told you before, in several videos, I have told you guys before that interest rates are on a downward trajectory. The curve is slanting downwards. Why am I saying that? Remember the central bank for US reduced their rates. The central bank for Kenya also reduced their rates. When the US Federal Reserve reduced their rates, I told you that rate reduction or that rate cut in US would affect Kenyan rates as well. And I told you it will affect Kenyan rates because the investors in US will be looking for other attractive investment options in other markets. And Kenya is one such market that the investors in US who wants to get alternative or better investment options can opt for. All right? So we are seeing diaspora remittances. Diaspora remittances now being the Kenyans working outside, Kenyans in USA, remitting in more money. They are now opting to invest home as opposed to investing there. Or rather, they're reducing their investment in the US and investing here. They're taking up the Treasury Bonds more and taking up deposits, our deposits more, and even the MMFs, yeah? Now, our central bank, CBK, also reduced its rates by 75 basis points, okay? So that, and we are also already seeing commercial banks also reducing their rates. Now, your money market account, your fund manager normally invests your money in government securities, that is the Treasury Bills. They also invest in bank deposits and commercial papers. That is the main investment options that they have. The Treasury bill for last week, we saw it at the lowest. It had hit the 14 mark. Previously, it was at 15 points. And prior to that, it was at 16 points. This is the 91-day paper, the 3 months T-bill, yeah? In prior months, it was at 16 points, then it reduced to 15 points, and now last week's auction, we saw CBK accepting an average of 14 points for the first time in so many months, since I think 2022. So that is an indicator that the rates are coming down. It's actually not an indicator now, but it's proof that rates are coming down. And if your money market fund manager was investing in Treasury bills, and initially they were getting bills at interest rate of say 16% or 17%, and now that Treasury bill interest rate has been reduced to 14%. What does that mean? It means that the income that your fund manager, that your MMF will be earning from investment in Treasury bills will reduce. And because your fund manager, your MMF income is not guaranteed, they pay you interest based on how much they have earned. They pay you interest at the end of the month based on its performance. So because there is a reduction in the interest rate for the Treasury bills, expect your fund manager to make less income from its investment in the Treasury bill going forward. All right? And that reduction in income earned from the investment in the Treasury bill will then mean that your fund manager, your MMF, will be having less money to pay you at the end of the month. All right. I had told you also the relationship between the interest rates paid by the bank on your deposits and the treasury bill rates. When the treasury bill rates are low, your bank also reduces its deposit rates. When the treasury bills are higher, your bank also increases the deposit rates. Why? I'll explain to you. Remember, your bank is in the business of buying and selling money, quote unquote. They are in the business of receiving deposits from the public, you and I, and lending this money to people who want to borrow loans, to take loans for their businesses or for personal use. Okay? Now, if a depositor, if you had your deposits at the bank and the bank was paying you 13%, for argument's sake, yeah? And then at a time when the treasury bill was at 14% or 16% or whatever amount that is, and then the interest rate for the treasury bill increases to 19%, it is logical for you to want to remove your money from the bank and deposit it in and invest it in the treasury bill so that you can earn more. That is very logical, and that's what is expected. Now, in order for your bank to attract back your deposit, to stop you from removing your deposit from the bank and investing in the T-bill, because it needs the deposits for it to run its business, yeah, for it to be able to lend out money. The bank will increase its deposit rate to say 18% or 19%, so that the T-bill, which is now at 20% or 19%, becomes less attractive to you. Now, the same thing happens. The reverse happens also. If the T-bill comes down, initially it was at 17%, now it's at 14%, and the bank was paying you deposit at 14% at a time when the T-bill was at 17%. Now, if the T-bill reduces to 14%, your bank will also reduce its deposit rate. Why? Because you have no other option to go to. So, because even if you withdraw it, you just take it to another bank in the industry, but you'll not be taking it to the T-bill. Why? Because the rate has become less attractive. Your bank will also reduce its deposit rate. Okay? And remember, your fund manager invests in treasury bills. They also invest in bank deposits. So when they now access bank deposits or fixed deposits in the bank at a lower rate, it means that the income they'll be earning from that investment in the bank deposit or in the fixed deposit will reduce. And when that reduces, they have less amount to share with you. Okay? So a reduction in interest rates, in the T-bill rates, a reduction in the fixed deposit rates will mean that you are going to see a reduction in the interest that your MMF will be paying you. That does not mean underperformance. No, they are controlled by the rates in the economy. It's one financial sector. Okay, so expect your money market fund rates to come down. All right. Now, does that mean that the MMFs are not a good investment option now? Not at all. Does that mean that you need to withdraw your money from the MMF account and look for better opportunities? Which better opportunities are these? Because even the T-bill rates are coming down. Remember, the money market fund accounts, your MMF is serving your purpose. Besides earning you passive income, that is where you save your emergency funds. That is where you save your sinking funds. That is where you most likely save your school fees and whatever other function that you are using your MMF for. So, in as much as your interest rate for your MMF are coming down, it does not mean that it is time for you to exit your MMF. Do not panic. That is how the economy is like now. At a later date, the rest will still go up. Okay? But if you're a business person, you're better off with lower interest rates, because then it means that the economy is just about to stabilize, or the economy is stabilizing. Please press the subscribe button and see you on the next video.